Hello and welcome. In this video, we will be taking a look at an ETF which I had been tracking for quite some time. Given its unique structure, I wanted to see how it performs over a period of time, and to be honest, it has not disappointed. This ETF is BTGD, which is the stacked 100% Bitcoin and 100% gold ETF from Quantify Funds. ISBG is the covered call version of BTGD. These two ETFs have a unique structure where they use 100% leverage, but the leveraged portion is allocated to a completely different asset from the primary holding, allowing investors to receive 100% returns of two different assets, and at the same time avoid the possibility of volatility drag, which is quite common in highly leveraged ETFs. So far, BTGD has performed as expected, that is, giving an average return of its two holdings, gold and Bitcoin. Although ISBG is relatively new, I believe it should perform similar to BTGD because the only difference between them is the addition of covered call writing. So in this video, we will be taking a look at three things. First, we will discuss the main strategy of these ETFs, which is return stacking, and how it is more beneficial than a regular leveraged ETF. Second, we will take a look at the total returns of BTGD and compare them with GLD and IBIT ETFs. These two are the most popular gold and Bitcoin tracking ETFs respectively. This comparison will help us understand whether holding BTGD works better than holding either of these two ETFs. Last but not the least, we will take a look at the holdings of both BTGD and ISBG. One thing to note about these ETFs is that they use synthetic holdings instead of having direct exposure to gold and Bitcoin. Hence, it is important to understand how the holdings actually work. We will also cover ISBG's covered call strategy in this part to understand how much capital upside we could expect to capture in ISBG as opposed to BTGD. With all that highlighted, let's get started. Return stacking is the primary method through which BTGD is able to use high leverage while avoiding the pitfall of volatility drag. This is best demonstrated by the table we see on the screen. In this table, we are comparing BTGD with BitX ETF. BitX is the 2x Bitcoin strategy ETF. Both ETFs use 100% leverage, giving the investor access to 200% equity. However, with BTGD, this 200% equity is divided between gold and Bitcoin, whereas with BitX, the entire 200% equity allocation is towards Bitcoin. This results in something known as volatility drag. In ETFs like BitX, if the underlying holding goes down by 10% on a given day, the 2x leveraged version would go down by 20%. However, if the underlying holding recovers that 10% loss the following day, the 2x leveraged version will not recover back to its original value. This happens because the leveraged version lost a lot more value on the way down compared to the underlying holding. For this reason, highly leveraged ETFs are mathematically guaranteed to underperform their underlying holdings in the long term. This does not happen with BTGD, where both holdings receive 100% allocation. Hence, there is no volatility drag with either holdings. In other words, an ETF like BitX is meant for short-term trading, while BTGD is meant for long-term holding. Now let us take a look at how BTGD has performed when compared to gold and Bitcoin. BTGD is designed to provide combined returns of both gold and Bitcoin. So it would be interesting to compare how it performs against ETFs, which track each of these holdings. GLD and IBIT are very popular for tracking gold and Bitcoin respectively. The chart we see on the screen shows the total returns of these ETFs going all the way back to November 2024, which is their most recent common trading date. We can see that as of April 17th, 2026, GLD is the best performer with a total return of 81%, followed by BTGD at 64%. However, there was a period from May 2025 all the way to January 2026 where BTGD had been the best performer. This happened because both gold and Bitcoin had been on a bullish run during that period. However, as Bitcoin began experiencing a downturn, BTGD was dragged down along with it, allowing GLD to claim the top spot over the past 3 months. Even then, it is quite comforting to see that BTGD has a significant outperformance against IBIT by almost a margin of 50%, while its underperformance against GLD is only by around 17%. If Bitcoin goes on a bullish run, we might see BTGD claim the top spot again. I was also curious if BTGD was performing any better than simply holding gold and Bitcoin in equal proportions without any leverage. This we could easily check by calculating the total return of a portfolio which holds gold and Bitcoin in a 50-50 ratio. Over the same duration, this portfolio would have returned 48% as of April 17th, 2026.
which is 16% less than BTGD's total return.
We are seeing this outperformance even though over the past few months the markets have been quite bearish. If we look at when BTGD was at its peak on October 6th, 2025, we see that at the time its total return was 138%. A portfolio holding GLD and IBIT in a 50-50 ratio at that time would have returned 67%, which in absolute terms is a great return, would have been significantly lower compared to BTGD. So, BTGD appears to be outperforming simply holding gold and Bitcoin in both bearish and bullish markets. But now we take a look at the most important aspect of BTGD, its holdings. BTGD uses synthetic holdings to track returns of gold and Bitcoin. Hence, it is important to understand the additional risk associated with it. Also, we will take a look at the covered call strategy of ISBG, which is the income-oriented version of BTGD. So here we have the holdings of BTGD ETF. At the top, we have the two biggest holdings. Both of them are futures contracts. These contracts work very similar to option contracts, with the main difference being that in futures contracts, both the buyer and the seller have the obligation to execute the trade of the underlying asset at the agreed upon price at expiration. Whereas with options, the buyer has the right but not the obligation to execute the trade. Similar to options, buying a futures contract provides a leveraged effect. This ensures that the fund is able to get leveraged returns without using any actual leverage. In essence, this helps them save on the cost of borrowing. At the same time, they are required to maintain collateral, which is where we have these two holdings, cash and FGXXX, which is a mutual fund mainly investing in government bonds. In addition to futures contracts and collateral, we see three ETFs on this list designed to track the performance of Bitcoin and gold: BITO and IBIT for Bitcoin and GLDM for gold. Among these funds, IBIT and GLDM actually hold Bitcoin and gold respectively, whereas BITO tracks Bitcoin price using futures contracts similar to BTGD ETF itself. So, among all these holdings, only the two holdings at the bottom of the table hold actual Bitcoin and gold. Everything else is based on derivatives. This is not necessarily a bad thing, but something we should be aware of. Now let us take a look at ISPG's holdings as well as its covered call strategy. The very first thing we notice with ISBG is that it has a longer list of holdings than BTGD. This makes sense. After all, this ETF is trying to do everything that BTGD does and then generate income on top of that. As of the making of this video, ISBG has an annual distribution rate of almost 20%, which in my opinion is quite low for an ETF which uses 100% leverage. If you look at most high yield Canadian ETFs, they are using 25% leverage and generating anywhere between 15 to 30% yield. So with 100% leverage, the yield ideally should have been a lot higher. But the lower yield suggests that they are trying to maximize capital gains in this fund. With that in mind, let us analyze the holdings. The overall structure of this fund is very similar to BTGD. We have the long-dated call options for both gold and Bitcoin, which serve as the primary instrument for replicating the price of gold and Bitcoin with a leveraged effect. Similarly, they have collaterals in the form of cash and a fund that invests in government bonds. But in addition, we have the short-dated puts and calls, which is where they generate income in addition to giving us leveraged exposure to gold and Bitcoin. So there are two things that stand out here. First, their covered call writing strategy, which uses a combination of both call and put options. In essence, this is not a classic covered call strategy ETF, but rather a combination of put write and covered call strategy. This is definitely a more dynamic approach than simply selling covered calls, but in absolute terms, I do not think it would result in any major difference when it comes to total returns. From the perspective of total returns, selling cash secured puts and selling covered calls are very similar strategies. In both cases, we are sacrificing the potential upside for receiving the premium upfront. One advantage that selling puts has over covered calls is that it lowers the capital requirement since the position is secured by cash rather than the underlying holding. Nonetheless, writing covered calls is still the overall superior strategy, especially out of money covered calls, which allow us to capture a portion of capital gains while also receiving premiums. At the same time, the lower capital requirement with put options is definitely tempting, and I think this is the primary reason for using them as it allows the fund to minimize the percentage of portfolio on which options are written. Based on the percentage weightings mentioned in the last column, if we do the math, option writing is done on roughly 17% of the total portfolio, which means 83% of the portfolio is available to capture capital upside during bullish markets. In my opinion, that is excellent for an ETF paying around 20% annual yield. The second thing that stands out, and in my opinion quite important, is the use of long dated flex options for tracking the price of Bitcoin and gold instead of futures contracts used in BTGD. This was something that completely stumped me initially. Why use futures contracts in BTGD but flex option contracts in ISBG? After doing some digging, I found that there are some unique tax advantages that options provide over futures contract. There is something called the heartbeat trade, which is essential for minimizing the tax obligation in ISBG. You see, ISBG is not just trying to give us exposure to the price of gold and Bitcoin, but also helping maximize income generation by selling call and put options. This additional trading activity necessitates two additional activities within ISBG which are not required in BTGD. The first, quite obvious one, is trading short-dated call and put options for income generation. The second, less obvious one, is the more frequent rebalancing of long-dated flex options whose primary purpose is to track the price of gold and Bitcoin, but they also serve as collateral for covered calls. Depending on the amount of covered call written in a given period, rebalancing of these long-dated flex options becomes necessary. Any capital gains from both these activities will result in additional tax obligation for the ISBG ETF. This in turn will negatively impact its long-term total return potential. To avoid this, the fund uses a trading tactic known as the heartbeat trade. And this right here is the reason why this fund uses long-dated flex options instead of futures contracts. The heartbeat trade is a tactic which allows funds to write off their capital gains. Without going into too much technical details, a heartbeat trade allows a fund to rebalance their holdings with high unrealized capital gains without triggering any taxes. This is generally done with the help of market makers. The important part here is that the heartbeat trade cannot be executed with futures contracts. Tax regulations for future contracts are different from tax regulations for options. Hence, the heartbeat trade will not result in any tax savings with futures contracts, but it will work with options. Hence, the use of flex options instead of futures contracts in ISBG. This, however, also begs the question, why not also use flex options in BTGD as well? After all, that fund could also benefit from the tax savings even if its holdings are not being rebalanced as often. The simple answer is that futures contracts are more accurate at tracking the price of the underlying holding compared to flex options. Since the primary goal of BTGD is to provide total return, futures contracts are the better choice for tracking the price of its underlying assets, whereas ISPG's primary goal is to provide income and its secondary goal is to capture as much capital value of its underlying holdings, while at the same time trying to minimize its tax obligations. For this reason, flex options end up being the more appropriate choice for ISPG. So, in conclusion, what is my verdict on BTGD and ISPG? To be honest, when I first heard about these funds, I was genuinely intrigued how they planned on achieving the total return for two separate assets in a leveraged ETF. I expected their expense ratios to be quite high, but right now the expense ratio of BTGD is 1.05% and for ISBG it is 1.14%. This is very much comparable to most leveraged ETFs on the market, except these leveraged funds are actually designed for long-term holders. There is a good amount of complexity with the way these ETFs are structured, especially ISBG, which leaves us at the mercy of the management's ability to ensure long-term success. But I would also add that this is true for most ETFs with any kind of active management. So anyone holding a covered call ETF in general should be comfortable with that particular aspect of these funds. In my opinion, these are great structured leverage ETFs and a perfect buy for someone interested in the underlying holdings. Since both these ETFs are listed on the US market, I need to address the tax impact of holding them in a Canadian account. Let's start with ISPG because that is the income generating ETF. Holding this in a regular cash account would result in the highest tax obligation, as we would end up paying 15% withholding tax on the US side, plus any applicable capital gains tax on the Canadian side. In a TFSA, we are only paying the withholding tax, which brings down our distribution rate from 20% down to 17%. In a RRSP, we are not paying any taxes at all. However, when we decide to withdraw the money, it could result in a tax based on the marginal rate, which could be anywhere between 12 to 25%, depending on the total income for that year. And obviously, it will vary from one person to another. With BTGD, we do not face the issue of withholding tax. In a regular cash account, it will keep accumulating its total return and only result in a capital gains tax when we decide to sell it. Similarly, we are not paying any withholding tax in a TFSA, and also there will be no capital gains tax whenever the position is closed. Also, there will be no taxes when we withdraw from TFSA. However, with RRSP, we get all the benefits we get in a TFSA except when it comes to withdrawal. When withdrawing from RRSP, we could get taxed anywhere from 12 to 25%, once again, depending on the total income for that year, and it will vary from one person to another. Also, depend on which province you are in. So, in my opinion, it is best to hold BTGD in a TFSA because that is the only option where we are avoiding paying any taxes at all. With ISBG, depending on where you expect to pay less tax, either TFSA or RRSP could be a better choice. With that, we come to the end of this video. Let me know in the comments if you hold either of these two ETFs or are planning to buy in future. As always, all the information presented in this video is based on my research and contains my opinions. Make sure to do your own due diligence before making any investment decision. Thanks for watching. If you found some value in this video, don't forget to like, share, and subscribe. I will see you all in the next one.